Hey, I hope you and your families are doing well. I'm going to try and make this the only MINERVINI volatility contraction pattern video that you need to watch on YouTube. To do that, I'm going to break this video into four main parts. Part number one is going to be at the pattern recognition side of things. What does a volatility contraction pattern, also known as a VCP, look like? What does it look like? How do you spot it on the chart? How do you see it on the chart? That's what part number one is going to be all about, and the real nuances. We're going to go deep into the weeds here. Now, a lot of the videos will just stop there. Okay, this is what a VCP looks like. Okay, great. Cheers. Thanks for coming out. But what we need to do is go into part two, which is, okay, great. You've now identified a VCP on the chart, but how do you enter the position? What is the order entry method technique? So I'm going to take you through buy stop limit orders and opening range breakouts and the pros and cons of each of those. Then the third part is going to be the key fundamentals. What are the fundamentals that you're looking for? So now we're marrying up both the fundamentals and the technicals. Okay, we're looking for the superstar stocks. And then the fourth part is going to be great. You've learned about VCPs, how to identify them. You've learned about order entry method techniques, the fundamentals. But now how do you scan for them? And how do you scan for them really, really quickly? You don't want to sit there for 5 hours. So how do you scan for them really, really quickly? Is there a way to do that? There is a way to do that. I'm going to take you through that in part four. Before we get into it, I'll let you know that Market Search are today's video sponsor. If you're interested in a discounted trial, there is a link in the description and the comment section below. You're going to see those charts in part number 3 when we're taking a look at NVIDIA and also app loving. Okay, so part number 1 of 4. What does a volatility contraction pattern look like? As you would imagine, this is quite an essential element of your learning to trade VCPs. You need to be able to identify it, to see it, to spot it developing on the charts. So this is where we're going to start. As the old saying goes, a journey of studying 1,000 charts starts with a single chart. There's no old saying around that. I just thought it sounded quite cool in a YouTube video, so I said it. There we go. But let's get into this, right? We're going to go ridiculously in the weeds here. There are so many nuances, and what I want to do in this video is get across the nuances to you so you really understand them. So to do that, I'm going to show you Cyrus Logic, which is my favorite example from the MINERVINI books in terms of a VCP, what I think is a ridiculously good one. And then what I'm going to do is take you through 4 stocks that I targeted and traded: Pins, KD, IBM, and Palo Alto. Okay, so I can really explain what I look for when I'm trading VCP type setups. And then I'm going to take you through AMD as well, which I was targeting, but I didn't get filled because I was using a buy stop limit order, and I should have transitioned over to an opening range breakout when the stock gapped up. So we're going to have a discussion around that, pros and cons of different order entry method techniques, then part 3, then part 4. So let's start here. This quote is really important. Okay, really important. You may just glaze over it, but it's actually really important because a lot of people think you're looking for a pattern. You're not looking for a pattern as such. You're looking for a characteristic that occurs within patterns. Stay with me. So VCP, volatility contraction pattern, is not a separate pattern from a cup with handle, a power play, which is a high tight flag, inverse head and shoulders, double bottom, cup completion, cheat, etc., which is a low pivot. You'll see one of those with Palo Alto. It's a characteristic of the patterns. It's a characteristic of the patterns. Yes, it does map out a pattern, but it can occur within any of the above. This is really key. So now if we take a look here, this is then what I blathered on about here, okay? This is the key of this video. In the blue zone. Okay, this is what I want you to start training your eyes to. Okay, because a lot of you will be thinking, well, I just look for 1 contraction, 2 contraction, 3 contraction, then I just buy it there. Not so fast. Okay, not so fast. Slow down a little bit, okay? So narrowing, tightening price ranges in conjunction with volume drying up and the stock is in a powerful uptrend displaying relative strength, then the tightness and low volume occurs with specific candlesticks on one or more key moving averages, being the 10-day EMA, 21-day EMA, 50-day SMA. So I don't know if you've noticed, I'm not Mark MINERVINI, I'm Jack. So I'm going to teach you how I trade them, how I look for them. But what I've done is studied Mark MINERVINI's kind of VCP and the concepts essentially, or very thoroughly I should say, really thoroughly, and picked out what I think are the creme de la creme ones, and I try and trade those because what I'm trying to do when I look at a VCP, I link it back to supply and demand. What is going on from a supply and demand perspective? And now we start getting into the nuances, okay? Now we start getting into the nuances. So let me give you a little bit of a broad overview here, okay? So you can see the stock is in a powerful uptrend. So this is the one from the book, but this is my favorite example from the book. So the stock is in a nice uptrend. The black line is the 10-day EMA, the blue line is the 21-day EMA, the purple line is the 50-day simple period moving average, and you can't see it, but the red line down here somewhere is the 200-day SMA, simple period moving average, and the grey line is the 100. Focus, if you're just going to focus on 3, focus on the black, the blue, and the purple. Do focus on the red one as well. You'd like to see it trending up, the long-term trend, okay? as the stock is basing, you want to see it in an uptrend and then it starts to base. So you need to have an understanding of basic and common characteristics that occur within certain chart patterns, or you want to have an understanding of common chart patterns, I should say. So that's going to be your flags, your wedges, your pennants, your Davis boxes, your cup and handles, your VCPs, which also looks like an ascending triangle, channel, things like that, okay? Have a basic understanding of that. But now let's start getting into the nuances, okay? As the stock is in an uptrend and then it starts building that form of continuation type base, the best ones will find supportive action around one or more key moving averages. The ones to pay attention to is going to be the black, the blue and the purple line. Now the 10-day EMA for many stocks is going to be too quick. Okay, so the sweet spot is going to be the blue line, the 21-day EMA. So you see this here. See how you get this? This is called a shakeout demand tail. I'll teach you more about these candlesticks as the video goes. I don't want to do everything on the first one here with Cyrus Logic, but see how it bounces off the 21. That is a good sign. See here how it bounces off the 21. That is a good sign. So it's not just the stock is in an uptrend. You'd like to see it respect certain moving averages. 21-day EMA is going to be the sweet spot for many. You can then also, we're fast forwarding here, we're really fast forwarding, but you want to think of a trade. There are 4 components to a trade. Number 1, how do you identify a high quality setup? So next time you are down at the pub or you're out with your mate and he's talking to you about stock ABC XYZ, ask him, okay, great. Number 1, John, how do you identify a high quality setup? John, number 2, how do you control the risk? John, number 3, how do you mitigate the risk? John, number 4, how do you optimize profits? What are the selling rules, selling guidelines you are using to optimize profits, both in terms of monetary gain, but efficiency of the monetary gain? And John will look at you a little bit perplexed, right? He'll be like, what are you on about, Jimbo? Right? But this is the depth that you want to go into. Identify, control, mitigate, optimize. So we're going to spend a lot of time in terms of identify and controlling risk. Okay, that's why we're going to spend a lot of time in this video. We're not going to talk about too much about risk mitigation and optimizing profits. But you can see the stock. I got off track. That's ADHD for you. So you can see the stock. Okay, bounce off the 21. Bounce off the 21. These are constructive candlesticks. This is a shakeout demand tail. This is a gap down reversal bar, and then the tightness comes. So stock is in an uptrend. And then there are, with this instance here, there's more so 3 contractions with it, okay? You have contraction number 1, contraction number 2, contraction number 3. It doesn't always play out like that, as you can see with some of the other examples. But you see this blue zone. So this is the key. Stock is in an uptrend. It's displaying relative strength. This is the relative strength line. It's a free tool. Search my name on TradingView. You will find it, okay? It's this one right here. A lot of you asked me about the ADR percentage. It's this one here that you're going to see in a couple of minutes' time. But this is what you want to train your eye to. Okay, then Toby Corbell wrote a really good book where he talks about 2-bar and 3-bar setups. Okay, so that is looking for the tightest 2-bar and 3-bar ranges over the last 20 days. And that's oftentimes what can happen with the best VCPs. That you will identify, as in this blue zone here, an area on the chart where price gets really tight and the volume really dries up, but it's sitting on 1 or more key moving averages. Now, why do I say that? Because it helps you not to buy extended stocks. Then you're not like chasing the stock up here and you're not chasing it here. Wow, this bar is really tight. It's really, yeah, but it's like V-shaped. It's not a base. Okay, it's not a base. So it's continuation type bases where you see respect off of certain moving averages. They are what I found the better kind of candidates lead to. And then it tightens on 1 or more key moving averages. 10-day, 21-day, 50-day are going to be the ones that you see most often. So you see this tightness in price and the low relative volume. So this is then a key. Tightness and price, low relative volume means there is sweet FA in terms of supply selling that is coming to the market for that stock. If you don't know what sweet FA means, go and Google it. Okay, there's sweet FA. There is nothingness, hardly any supply. Before you buy a breakout, before I buy anything that I'd like to see it go up, I would like to see there's very little selling pressure. I want to see very little selling pressure because then it's well-trained traders that identify this and can take it into trend. Okay, this is what you're looking for. That is the VCP, volatility contraction, because there is a timeless principle of the market, Toby Corbell, go and Google him, which he discovered. The market moves from periods of contraction to expansion, and from expansion to contraction. That's just the wiggle and jiggle, how the market ebbs and flows. So what you're trying to do is know that, use that, utilize that, use that to your advantage. You're trying to identify areas of contraction, and then you're trying to play the expansion. Specific things should happen right after that bar, okay? And then that feeds into your process. It's really important. So let's go into some that I was targeting, okay? Pinterest. Now we'll go into some of the nuances. You get a good sense if it's the right stock, which we're going to be talking about in part 3 with the fundamentals. What did the bigger boys and girls do around the earnings? What did the JP Morgans do? What did the Fidelities do? What did the pension funds, the mutual funds do? What did the institutions do? Because that's who we care about, right? We don't care about retail traders. We're trying to follow the footprint of institutions. Do they want it? Do they not want it? And we want stocks that the institutions want. That's what I want to do, right? I want them on board. I don't want to fight the institutions. I can't fight the institutions. I want to be on their side. I can pick a side. I want the side with the institutions. So earnings gives you a really good sense, I think, of what did the institutions do. So I look at what did the stock do on the earnings. I don't look at the earnings report as per. I look at what did the stock do. Sometimes you can get a terrible earnings report on the face of it, but the stock's just gapped up and pushed 30%. Sometimes you can get a stock that smashed the earnings, smashed the sales side of things, raised full year guidance, and it tanks. So it's not as much what did the company say, what did they report, what did the stock do? So this is key. What did the stock do? So what you see here is you see an earnings gap. Look at the large relative volume coming through, and then this is good. Okay, this is a blue cherry. Okay, 52-week high on the relative strength line versus the S&P 500. The stock is outperforming the S&P 500. The really savvy, smart operators in the market, they want to be in the stocks displaying relative strength to the S&P 500 because oftentimes that is their benchmark. If they are not outperforming their benchmark, they get sacked. They lose assets under management. It's very difficult to outperform your benchmark if you're in stocks displaying relative weakness to your benchmark. So that is why the really savvy, really smart institutions go where there is relative strength. Stocks outperforming the S&P 500 because they want to outperform their benchmark. They are greedy. They want more assets under management. It's all very, very logical when you think about it. So we want to identify the stocks that the institutions are like, we want this. We want this. So take a look at the earnings reaction. Good gap up here, okay, good gap up. This is what I call a shakeout demand tail, and then it pushes up in subsequent sessions. Now the creme de la creme, the strongest stocks in the market will get supported on their 10-day EMA. But as I said, oftentimes can be too quick for a lot of stocks, including Pinterest as well. But Pinterest did get supported on its 10 here. Tight bar, tight bar, tight bar, then you get the real tightness, and look how the volume just stair steps down. You see it, how it just stair steps down. But I'm not chasing it. Here, I'm not like, well, I watched a YouTube video and this is like really tight in here, and no. It's got to be a proper continuation type base. Ideally, base duration, 3 weeks, 4 weeks minimum is what you'd like to see. But these post-earnings setups, consolidations, VCPs, whatever you want to call them, I absolutely love them. Really, really, really like trading them because I think you get a really good sense of what large operators are up to. Now we're going to go into another nuance, okay? You see the candlesticks. Do you see how generally they all look quite tight in terms of the real bodies, in terms of the overall spreads, and the volume stays pretty muted below the black line, which is the 30-bar average. That to me is a sign that there is just absorption of supply. There's not much supply coming to the market. So there is a prolonged period where volatility is contracted. It's good. It's really, really, really good to see. Now, guess what? Not everyone just powers out the gate on the first day. Sometimes they take a little bit of time to get going. Sometimes the market environment on the day that you're buying it just didn't know. The Q's a week, the SPY's a week. It just didn't want to go, and then it takes a couple of days. That happens. Okay, that happens. I'm a big proponent of bar by bar deliberate practice. Go do 1,000 bar by bar deliberate practice trades. You'll get a really good sense of actually how do stocks wiggle and jiggle. How do they go from point A to point B? It's really, really important to understand that. But this here, okay, see the relative strength line, okay? The relative strength line hits 52-week highs and then it stays pretty good throughout. Ideally, it can hit 52-week highs pre-base, in the base, and then post-base. That can mean onto a winner there, onto a leading stock. So let me talk about this one in terms of the risk a little bit more, okay? So oftentimes, what I'm then looking for, so again, I'm Jack, I'm not Mark. So what I'm then looking for is I'm looking for areas of contraction, okay? Where ideally with these VCPs, you start to get the narrowest 2-bar ranges over the last 20 days. Could be 3-bar ranges, could be 4-bar ranges, okay? Over the last 20 days. And then it's occurring on one or more key moving averages, and you get these really tight bars on low relative volume. It just means hardly any supply is coming to the market. Really, really, really good. So, okay, great. Now, how do I think about targeting this? Well, what I do is I'm often looking for a really tight bar on one or more key moving averages. I'm then buying it through the high with a buy stop limit order and stop loss just underneath the low. Now, the way I then think about risk is then relative to the stock's 20-day ADR percentage. It would have been a little bit lower here, but let's just imagine it's 2.45%. So let me explain this to you, okay? So this is the ADR percentage. This is important, okay? You're not going to find this in Mark's book, but I find this very, very useful in my own trading, okay? So the ADR percentage, the one I use if you go on TradingView is this one here by Arma. Never met the guy, but I like the indicator. So this one here, right? What does this mean? ADR percentage. Well, the average daily range percentage of Pinterest over the last 20 days is 2.45%. Is that important? I think it's very, very, very important, especially when you're considering the quickness of the stock and how much risk you are taking relative to the 20-day ADR percentage. So with the better VCP candidates where they get really, really tight like that, oftentimes what you can find is that the initial risk is half to 2/3. Oftentimes it can be less than half as well if they're really, really, really good like Pinterest here. But again, I've taken it from here. Here it would have been a little bit less, maybe closer to like 2% because this is kind of expanded in price. But anyway, I digress. So what I do is when I'm then looking at it, I'm thinking about the initial risk, which in this instance here, assuming perfect execution, is 1.15% versus the 20-day ADR percentage of 2.45%. So when you're looking for these VCPs, assuming the stop loss starts with under a 4 or a 5, okay, keeping it half to 2/3 versus its 20-day ADR percentage, I think is preferable. Okay, if a stock has a 20-day ADR percentage of 2.45%, I'm not going in with a 7 or 8% initial stop loss. The risk versus reward is way out of whack. I'm not doing that. Okay, so with these type of setups, I like to keep it half to 2/3. I think that's a really, really useful metric. Let's go on to another one. KD, doesn't it look quite similar? Really good earnings reaction. So you see this earnings reaction, look at the pop in the volume, look at the increase in relative strength. We like that. Then the stock pulls down to the 10-day EMA, puts in this inside bar. Oftentimes it can be an inside bar. I call these a trigger bar. It wasn't stopped out on the next session. The low of that bar was 17.79, so 2 cents off the low. I nearly got stopped out, but I didn't. But that's the entry candlestick there, okay? So then again, it's about thinking about the initial risk, 1.19%, relative to the stock's 20-day ADR percentage. It would have been a little bit less when it was here because I stopped it there, so that's the 20-day ADR percentage from this day here, so it would have been closer to 2.5%, say. But on this bar here, if we just imagine this 2.38%, I'm probably confusing a couple of you here, but the average 20-day range percentage, imagine when I'm targeting it here, is 2.83%. Okay, why don't we do this? Let's mix it up a little bit. There you go. No, it's 2.82%, right? So this is what I'm seeing, okay? When I'm going in, I'm targeting, I'm looking at this, right? And I'm like, okay, 1.19% off a 20-day ADR percentage of 2.82%, very, very, very favorable. The initial stop loss number 1 starts with a 1, which if you're swing trading off the daily chart and you've been trading longer than 2 weeks, you'll know that is a pretty darn tight stop loss. And then it is under half the 20-day ADR percentage. Volatility contraction. You got it. Let's do another one, IBM. So this one here, what do you notice about the earnings? Isn't that interesting? But it's not just, oh, the earnings there. Gaps up, so the prior closes here, gaps up, opens on the low of the earnings day, and then pushes up. The fact that it gaps, here's a nuance. The fact that it gaps, opens on the low of the earnings gap, and then pushes higher. What does that tell you about how immediate demand was? How quickly buyers showed up on that session? Think about it. The open is the lowest price of the session. Stock gapped, stock pushed. The presence of demand was immediate. Now here you kind of get this like quasi like bad looking bar underneath the 21 and then it just recovers. So it's more of like a shakeout, but right there looked horrendous, undercutting a lot of these low, lot of weekends getting stopped out because a lot of traders will put their stops underneath 21-day EMAs, underneath the low of earnings gap, underneath the lower base as well. I won't go too much into that right now, but this acts as a shakeout and then it tightens. So again, look at this, okay? Look at the tightness and price. Look how the volume dries up. Little uptick in the relative strength line as that's forming there as well. Really, really nice. Initial stop loss, about 1%. Less than 1% versus a 20-day ADR percentage of 1.7%. Very favorable. But you see how thinking about initial risk relative to 20-day ADR percentages is a useful exercise. Because some stocks will have 20-day ADR percentages of 4%, 6%, 8%, 10%, 12%. You go into cryptocurrency stocks, 12%, 15%, 20%. So we think about risk differently. It'd be very, very difficult to identify if you're swing trading off the daily chart like this, if a stock has a 20-day ADR percentage of 10% to get a 1% stop loss. Well, reasonable is probably going to be like 3, 4, 5% in those instances there. Okay, so this is how you kind of link back the character of the stock. You've got to understand the stock that you are trading as well. Another useful exercise is go back, study the stock. Where does the stock like to break out from? Does the stock like to base onto the 21-day EMA? You go back, study past breakouts. Does it like the 21-day EMA? Does it like to go off the 10? Does it actually like the 50? Let's go and talk about one off the 50. So this one here, Palo Alto, this is a low pivot. So what you see here is another one that had a good earnings reaction. See how it gapped up here? I got the wrong tool there. See how it gapped up here, opened on the low, pushed up, okay, sold off, bounces off the 10 here, and then it starts developing this little low pivot, really good volume coming through. I'm going to go down onto the 1 hour chart for this one, as for this one as well. Let's do that, right? Let me give you a good sense of what I'm looking at here again. So here we go. This is what I'm looking at the moment in time here. There we go, we can fit the data like that. So I'm looking at this here. Now, a nice location to look for these bigger stocks, which Palo Alto is a bigger stock, is when you get a clustering of the black, the blue, and the purple line. 10-day EMA, 21-day EMA, 50-day simple period moving average. I like it when we start seeing tightness develop around that. So remember, volatility contraction pattern. They do not all look like this. It's an uptrend, 1 contraction, 2 contraction, 3 contraction, 4 contraction, breakout. Don't look like that. As I read the quote out to you earlier, volatility contraction is a good characteristic that you will identify in other chart patterns. So cups with low handles, divers boxes, pennants, wedges, channels. Okay, but this is key. Knowing where to look for the tightness. 10-day, 21-day, 50-day, clustering of those. As I said, 10-day for a lot of stocks will be too quick. 21, 50, going to be more so your sweet spots. You've got to think about the type of trader you are as well. If you're trying to sit for bigger moves, you may be looking for stocks around 21s or 50s as opposed to 10s. Okay, you've got to think about that. So on this bar here, right, I'm looking at this. So I was targeting it through the high of this bar, so 1.24% assuming perfect execution. I'm going to go down to the 1 hour chart in a second, because then we're going to flow into AMD and I'll show you the order entry method technique, which is a buy stop limit order. So I'm looking at this on the daily chart and I'm like, okay, prior session actually opens on the low and pushes up, good sign, volume around about 30 bar average, then you get this bar here, in essence, an inside bar, a little shakeout demand tail, volume below the 30 bar average, RS line has been just ticking up there, 1.24% off a 20-day ADR percentage of 2.16%. I like it. Let me go down to the 1 hour chart, because you can get a real good sense of things, I think, on the 1 hour chart. I don't know what TradingView's done, I don't know if you guys have noticed this, like they've messed up their thing. How they're like scaling. Like, what are you doing, TradingView? What on earth are you doing? Can you see the tightness coming through here? I don't know what it's doing, guys. Why are you doing that, TradingView? Why are you doing that? Anyway, I digress. So let me just do this here, zoom in a little bit. So you can see the tightness coming through here. Now it looks pretty skew here. So what I'll do with a buy stop limit order is I will set it to, I want to know, okay, with this type of stock here, where do I want to try and buy it? And something like this, I may be actually trying to buy it tight, but I'm just going to do this here. 231.51, let's do something like that, 231.51. So with a buy stop limit order, okay, what I'm doing is I'm defining the risk, because what I'm trying to do is buy this stock within the range of $2 at 237.30 to 238.51. So if I just delete this blue zone here, okay, what I'm trying to do is I'm trying to buy the stock within this range here with a buy stop limit order. So the buy stop is a trigger price. So when price goes through 237.30, that's the trigger. Then the order goes to the market, and the maximum I'm willing to pay for any shares is $238.51. If I mispronounce any of those, it's because I have dyslexia and sometimes I read letters and numbers wrong. But anyway, here, right? Now, why is that useful for me? Well, because then I know, well, what's my maximum risk on the trade? If I'm defining the maximum amount that I'm willing to pay for any shares, guess what? I can define my maximum risk. So now I know, oh, my maximum risk is going to be circa 1.71% versus the 20-day ADR percentage of 2.16%. It's about 2/3. It's still okay. It's still okay. I'm still happy with that risk. Okay, if I'm not defining my risk ahead of time, I'm just like willy-nilly, I'm not defining my risk, I have no plan, everything is random, it's haphazard, it's not going to go well. Been there, done it, have the t-shirt, currently got a striped shirt on, quite like my striped shirt. But I define everything ahead of time, okay? ADHD as well, for me, it's useful. Define it, okay? Rather than impulsively be like, oh, it's breaking out, FOMO, da-da-da-da. Woosa, as they say in Bad Boys, woosa, okay? Just slow it down. So I like buy stop limit orders. Okay, that's my preferred order entry method technique. However, there's sometimes where ORBs, opening range breakouts, can be better. So let's see if TradingView wants to let me do this. So this is AMD here, okay? This is a ridiculously good setup. And I didn't get filled on it because I was trying to do a buy stop limit order. So what I was trying to do is I was trying to buy it within 0.5%. So something like this here, I'm just going to go 177.77 actually rings a bell. No, maybe it was that level. Okay, so what I'm trying to do is I am trying to buy the stock with a buy stop limit order because I'm trying to define my risk, right? I'm trying to buy it through the high of this bar here. Now AMD, fairly liquid stock, okay? If they're less liquid stocks, they're going to be harder to get filled. AMD, pretty darn liquid stock, right? So I'm trying to buy it with a buy stop limit order between 176.84 and 177.77. There's a lot of sevens there. So as it moves through 176.84, that's the trigger price for the buy stop. Then the limit gets attached to that as well. So I know the maximum that I'm willing to pay for any shares is 177.77. So then I know my maximum risk. My risk on the trade is going to be somewhere between circa 1.84% and then about 2.5%. Now for 20-day ADR percentage is circa 4%, that's really favorable. But you see this here, right? It doesn't look like you're kind of, yeah, it's in an uptrend, 1 contraction, 2 contraction, 3 contraction, and then it breaks out like that. Like, they don't look like that, guys, okay? And actually, the vast majority don't. That there is an ascending triangle pattern. It's just an ascending triangle. What you're looking for is the areas of tightness, okay? Tightness on a relative basis. 2-bar, 3-bar ranges where it just gets really, really tight. Look at just the dearth of volume as well. And then it's sitting on one or more key moving averages. The 10-day, the 21-day is right there. The market will go from periods of contraction to expansion. The market, individual stocks, financial instruments. That's just how they wiggle and jiggle. That's how they move. Go back and study them over the last 100 years. The market moves from periods of contraction to periods of expansion, as I hold up my pencil. It's just what it does. But you can see here, the stock gaps, so I don't get filled. Now let me go down to the 1 hour chart. Hopefully it's going to let me do it. If it's not, I'm going to get really irritated. There we go. That's what I wanted to do on the last chart. Why didn't you let me do it, TradingView? So, as we were saying, right, let me pull this across like this. So, what I was trying to explain on the last chart, let me do it. There we go. Okay, so I was trying to buy it within this blue range here, okay? Circa between 176.84 and 177.77. This is where I was trying to buy it. However, I didn't get filled on it. Why? Because it gapped. So I was trying to buy it here within 0.5% and it gapped and it opened about 1.69%. So now we can have a useful discussion around buy stop limit orders and opening range breakouts. Now, how much you can sit in front of the screens, this is part 2 of the video that I forgot to mention. So how much you can sit in front of the screens and when you can sit in front of the screens. So now we go into your daily routine. So we're talking about systems, how you identify and control risk, but now we're talking about routines. So you really want to focus as you're building out your trading process, your systems in terms of how do you identify, how do you control risk, how do you mitigate risk, what are the selling rules, selling guidelines that you use to optimize profits. But then you also want to think about your routines. Your routines are really, really, really important. Think about what are you doing on a daily basis for your trading. What are your trading routines? What are you doing on a weekly basis? When do you do your scanning? When do you plan your trades out? Do you not plan your trades out? That might be an issue. Then, what are you looking for? Are you going to be sitting there for the first half an hour when the market's open, see if these things break out? Because most of them will break out in the first half an hour of the session. Are you going to be sitting there? Are you not going to be sitting there? If you're not going to be sitting there, what are you going to do? Like, are you going to use a buy stop limit order? Just set it and forget it? Are you going to try, if you can stare at your screens, are you going to do an opening range breakout? What are you going to do? So you can see in this instance here, the stop gaps opens on, this is a really good bar by the way, opens on the low of the bar. Remember when we were talking about stocks earlier, I think it was IBM, earnings gap open on the low of the bar, pushes up, immediately goes. There is an immediate presence of buying, enough that they just take out all the sell orders and this thing just rips higher, okay? Like that, it's really good to see. So an ORB, maybe we'll go down to the 15-minute chart and let me just pull this across like this. So this is what an ORB would look like, okay? So I'm trying to buy it within the blue zone with a buy stop limit order. Hindsight 2020, of course it is, right? What I could have done is switched over like that, click all the fingers, and used an opening range breakout. So what's an opening range breakout? Okay, you're looking at a stock and you want to see it going through a specific level, or in this instance here, gaps up for a specific level. So then what you do is you buy it through the high and use an intraday time frame, which commonly is going to be the 1-minute chart, the 5-minute chart, the 15-minute chart, a half an hour chart, or the 1 hour chart. Take your pick, right? So here, through the high, stop under the low. So then be underneath, low of the day. That's the common way to do it, okay? So then your risk on the trade is going to be circa 1.87%. Are you happy with that? Are you not happy with that? Obviously, to do an opening range breakout, guess what? You have to be staring at your screen. You have to be putting the order in, okay? You can't be in a work meeting on your phone like, oh, it's going, I'm going to do this, sneak off to the toilet and da-da-da. Probably ain't going to work. So you really want to think about systems and routines. How do your routines fit around your trading process? How do you implement them into your trading process so you get better at it? So this is important. Are you doing an ORB, an opening range breakout, on the 5-minute chart, 1-minute chart, the 15-minute chart in this instance? Are you doing a buy stop limit order? If the stock gaps above your buy stop limit order, how long are you going to give it? Are you just going to cancel the order as soon as it gaps? Are you going to let it pull back and potentially fill? What are you going to do? Systems and routines. Really, really, really important. There's a couple of videos on the channel about order entry method techniques and some of the other videos. ORBs, buy stop limit orders. There are pros and cons to both. There are pros and cons to both, and much is going to depend on you and your personality, and also your routines. Can you sit and look at the screen for the first hour of the session? Can you not? If you can't, then ORBs probably aren't going to be effective for you. If you have ADHD, ORBs also may not be effective for you because you may be impulsive and do things that you didn't necessarily want to do. Let's go into part 3, which is the fundamentals. So I'm going to show you 2 stocks. I'm going to show you AppLovin, and I'm also going to show you NVIDIA on the market search charts. If you're interested in a discounted trial, there is a link in the description and the comment section below. So let's start here with AppLovin. So it is a relatively new IPO, which is good. We like that. Now I'm going to show you the main things that I focus on. So let's start with that. Okay, my eye is drawn to here. This is the annual EPS. Now, what I like to see is that annual EPS is growing and the estimates are in all-time high territory, and the forward guidance, which is this little green arrow, has been raised. We like that. So if you think about this company here, is there a reason why this stock may go higher from a fundamental perspective? Darvis, I think, said it best. He said something along the lines of, ultimately, a stock share price is going to be based upon its earnings and its projections or estimates of future earnings. So it's really the earnings and the expectations of future earnings that propel and drive the share price higher. Okay, so it really is earnings and estimates of future earnings. The Warren Buffett quote: in the short term, it's a voting machine. In the long term, it's a weighing machine. Weighing being the earnings. So earnings are important. Okay, so pay attention to them. Earnings, sales, expectations of future earnings. It's what you want to see, and oftentimes will show up in the better candidate. So if you take a look at App here, the company goes from basically losing money 33 cents, losing money 9 cents, losing money 98 cents. But here's the kicker: 2024 estimates $4.64. Earnings estimates up 373% with the guidance being raised. Bit of a game changer, bit of a difference on a rate of change there. This green line that you see here, I like this new feature. See this green line? This is the EPS line. It's pointing to the stars. This thing is going to the moon, right? This is good to see. Really, really, really good to see. So this is something that I look for. Then let's go and take a look here, okay? So what we can see now is we can see the quarterly earnings coming through. So again, it's the same point that we're looking for with the annual EPS estimates. If you take a look at here, note the kicker, note the game changer. So on a quarterly basis, the company goes from losing 31 cents, losing 6 cents, making 6 cents, losing 21 cents, losing 1 cent. Ready? Then it reports 22 cents, 30 cents, 49 cents, and then the estimates going forward are for 75 cents, 83 cents, 69 cents, 75 cents. Triple digit earnings. We like that. Take a look at the sales growth. Ideally, you want to see sequential growth in terms of the sales. So take a look here. The sales on a quarterly basis 8 quarters ago were 625 million. Not bad. But now look how it's gone up to 953 million, and the sequential growth quarter over quarter. And then the estimates are for it to go over $1 billion in quarterly revenue in coming quarters. So think of the growth there. Okay, there's a lot of pieces of the jigsaw here, and we're trying to piece them all together, both from a fundamental perspective, but also from a technical perspective as well. So look at the earnings estimates. Look at what is going on in terms of the earnings on a quarterly basis. Triple digits, the higher the better. Sales, the higher the better. Take a look at the RS line as well. Okay, these are things that we want to look for. Then near 52-week highs, and even better if it's near all-time high territory. You can look at the ROE as well. Obviously, O'Neill, founder of IBD, MarketSmith, MarketSurge, okay, would like above 20%. 17-20% was like his minimum cutoff. The higher the better. So ROE, something good to look for as well. If I show you NVIDIA, so these are some of the best fundamentals you maybe ever see in your life for a company of this size, $2 trillion market cap. Okay, keep that in mind. But here's the kicker, right? If you take a look at the annual EPS, okay, so earnings are really important. Remember what Darvis said. It is earnings and expectations of future earnings that really propel the share price of a company higher. Earnings and expectations of future earnings. So that is what I'm dialed into and focused on. Earnings and expectations of future earnings. We want to see growth, a lot of growth. The more growth, the better. So if you take a look here, $1, $1, $1, $2, $4, $3, here's the kicker. $12, $23, $28 for the annual EPS. Estimates up 288%, 84% forward guidance rates, 21% forward guidance rates, and this is a $2 trillion market cap. Then we go and take a look at the earnings. Okay, ready? Same exercise. This is earnings on a quarterly basis. Okay, $1, 50 cents, 50 cents, 80 cents, $1, $2.70. Ready? $4, $5, $5, $5, $6, $6. Mega rate of change. Look at the triple digit earnings coming through. Take a look at the sales growth. I cannot tell you that I've ever seen this in terms of a public traded company with a market cap of this size. This is sales on a quarterly basis. And this is B for billions. So it's a big number, okay? Take a look 8 quarters ago. NVIDIA reported on a quarterly basis $8.3 billion in quarterly sales. Look at the most recently reported quarter, $22.1 billion. In the space of 8 quarters, NVIDIA's revenue on a quarterly basis has gone from 8 billion to 22 billion. To repeat that, in the space of 8 quarters, NVIDIA has gone from reporting $8 billion to 22 billion. And the estimates are for it to go to 24 billion, 27 billion, and that looks like a 28 or a 29 billion. Look at the EPS line. Look at the high quality funds. Look at the ROE, return on equity, 99%. EPS growth rate on a 3 to 5 year look back, 45%. Bonkers. These are the type of things that you really want to see from a fundamental perspective. These are really, really, really key. So just to summarize, annual EPS estimates, you want to see it trending up and you want to see it going into all-time high territory, forward guidance being raised, big estimates coming through. Ideally, of course, the company has global product, new product involving a new revolutionary technology, such as artificial intelligence, right? Quarterly EPS, you want to see the same. Okay, figures accelerating, triple digits, the better. All-time high territory over the last 8 quarters. So i.e. the EPS being reported on a quarterly basis is into all-time high territory over the last 8 quarters. Same with the sales. So sequential growth in terms of the quarterly earnings, the quarterly sales, the annual EPS, everything getting better, high ROE. These are the things to notice. RS line, like that, to the moon, those kind of things. That is what you want to see. Okay, really, really, really good. Okay guys, we're into the fourth and final part of this video. I think we've come a long way. Part 1, we looked at how do you identify a VCP? What does it look like? Part number 2, order entry method techniques. Part number 3, key fundamentals. But now we're into the fourth part, which is the final part of the jigsaw puzzle. How do you quickly and efficiently scan for those type of setups that I was teaching you in the video? Don't worry, that's where my custom built stock screen hero comes into its own. So what I've got here is a preset screen that I'm going to be taking you through. I've got some other ones as well, like I've got a contraction scan on a 7-day basis where the range is in 5% and the 20-day ADR is greater than 1.5%. But I'm going to take you through this one here. Okay, the contraction scan on a 2-day basis where the range is in 3%, price is above the 50-day, above the 200 days. We're trying to make sure the stock is in an uptrend. The average daily dollar volume is greater than 1 million, help filter out all the really illiquid stocks, and the 20-day ADR percentage is greater than 2.5%. You can create your own screens if you remember as well. So price contraction is a pretty cool new feature we've added. So you could set it to somewhere between 2 days and 7 days, and then you can select the range as well. So you're looking for areas of contraction. Then you can add some other cool things as well, right? But what I've been able to do here with this preset screen is take our database of US stocks down from around about 5,500 to just 42. Just 42 stocks, so super duper quick and efficient, right? We could then look at the results in different ways. We could select this here and we could go, okay, we want to look at the stocks displaying the highest relative strength on a 3-month basis. We could do here, we could look at the stocks with the highest 20-day ADR percentage, so the quicker stocks first, or we could look at the most liquid stocks first by doing it on an average dollar volume over the last 50 days. So we'll do that. You could also go bulk actions here, export all to TradingView, TC1000, Market Surge. That'll put it in a .txt file, so you can just copy them in, import them in. You could do it all to an Excel spreadsheet and copy them in that way if you want to. So let me just go charts here. Let me show you how quick this is, okay? So we're looking for stocks in the context of an uptrend that are trading within a narrow range, within a tight range. And you still got to do a little bit of work, right? You still got to use your eyes and then identify the setup. But this multi-chart layout, where they're just side by side to each other. So you've got PSX here just pulling down 10, 21 and 50, okay, just underneath it, but potentially tightening. But you can see how we're just identifying these stocks that are starting to tighten up. And you'll also notice, okay, am I seeing a lot of oil and gas stocks setting up in this screen? Is it semiconductors? Is it solar? Is it software? You get a sense of relative strength as well. STNG, see how this is starting to tighten. Decent size base. You can zoom it in, you can zoom it out like this as well. There's some pretty nice functionality. I'd encourage you to go and try it. There's a couple of preset screens coins that are free as well in there. But like this one here, which is PLMR. Okay, we can see here we've got a nice pop. This may be earnings. Again, nice pop here as well. Okay, bounce off the 50, which is going to be the purple line here. And now see how this is starting to tighten. Okay, looks pretty interesting. So yeah, I'll wrap the video up there, guys. Hopefully that there was a useful deep dive into volatility contraction patterns in terms of how you identify order entry method techniques, thinking about fundamentals, and then finally how you can quickly screen for potential VCP setup. So thank you very much for watching the video. Thank you very much for all the support on the channel. I really do appreciate it, and I look forward to seeing you in a future video.